Okay, this is Mike again. This is part 2 of 2, or part 2 of the second part. So it's part 3, but it's part 2 of the second part. Taxing rich people. So subtraction value added tax has 2 pieces. The first piece is the part where we pay for the children and the health care. The second part is a surtax. So if somebody has a higher income, they don't have to pay their own taxes. But if a company's pays over $110,000 to any employee, up to that wage base from $100,000 wherever Social Security stops, to a couple of tax brackets up, if all of your money paid to this chunk goes, is paid into a subtraction VAT surtax. So instead of individuals, because the companies collect it anyway. So instead, just have the companies collect it and at the higher rates, and then use it to either send it to the regional government or a little extra to make sure everybody's health taxes are taken care of, or education. There's multiple ways to do that, or send it, have some of it go to local defense or even national defense, and paying back the debt. That's a good one too. Although actually, you could have a high income surtax. Is the only people who would pay taxes, and that's at the $435,000 a year level. That's about where Joe Biden would have no tax cuts going up, or below that. I would say nobody below that should pay any income taxes at all. Let the employers pay, and people don't have to fill out their forms. They collect it, they write the check. You might as well let them reconcile it. The only things that would cause somebody to have to file are any capital gains, any higher tax level, and because it's value added, dividends are already included in the tax base. All of the companies' value added would be included in the tax base. So you'd have the company would pay out money internally, but they collect it now, but you don't have to have people file taxes except for capital gains, and I would get rid of that one too. I would switch out capital gains and the death tax and replace it with an asset value added tax. It would be zero rated. If you sold your shares in a company, both in the open market, which would be new, or in the private economy, which you can do now. Right now, if you own a company, you can sell your employees under what's called an ESOP, Employee Stock Ownership Plan. That should be expanded to people who want to sell their shares in a business on Wall Street, so they can sell. So they wouldn't pay their asset value added tax if they sold it to an ESOP. Otherwise, you'd pay whatever the rate is at the transaction level. So instead of paying at the end of the year your balance, which means if you lose money, you can write it off. No, every transaction should be paid at the same rate. And then you can from the difference between for what you bought it to what you sell it. That's your value added, and you pay taxes on that. So you pay the tax on the whole amount, but you get a refund from what you paid in. It's a value added tax, but you can do it for financial instruments because gambling is a consumer expense on Wall Street. Let's call it what it is. It's not, we're not talking about real investing. We're talking about gambling, and gambling is a good. It's it's a lottery ticket in a lot of cases. So yes, every share should pay a value added tax. So there's that. And it's set to 0 for or it's set to zero if you are selling to ESOPs, but it's marked to market at option exercise, at initial public offering, and for the first sale after inheritance, gift, or donation. So let's say you give shares to the Tax Policy Center. They have the shares, but if they sell them for operations, then they pay the asset value added tax marked to market, meaning they pay the full value. And if an heir keeps the money keeps a business going, then they don't have to pay the tax. But if they if an heir sells their business to somebody else, or their shares to somebody else, takes them out of the family business, then they should pay full taxes on them. And that should be marked to market. And of course, the person who buys actually pays the tax. But the person who sells keeps less. If they're selling, if they bought it and sold it, then they would get a break on what they paid for the shares. But if you just get the shares, then you should pay the full value of the shares. And that gets rid of the need for a death tax. That and a credit invoice tax. And it also gets rid of the need for having big insurance policies, and all these instruments and all these savings plans that are designed to defer trusts. And all these instruments where you borrow money against your shares and spend it. If you have a credit invoice tax and an asset value added tax, if you've got the cash and you either invest it or you spend it on a new boat, then you got to pay the tax. So you can't avoid paying your taxes by avoiding the income tax, because there would be no income tax. The only time I would have an income tax is, again, for really high income people who would have the option of prepaying their tax on income over 435, and there'd be various levels up to $1 million, and you could prepay your taxes through what's called a tax prepayment bond. And in a lot of high wage situations, they've got a contract and it already specifies that, so you can pay in advance. And if you do enough of that, you then write the check to the Bureau of Public Debt rather than the IRS, because there'd be no IRS, because the states would collect the subtraction value added tax and the credit invoice value added tax, so there'd be no federal filing. If you're a business owner, you'd have to file, of course, a more detailed return, but it's still a VAT. It's still very simple. What did you buy? What did you sell? What tax? Take off the taxes that you bought as deducted from the taxes where you sell the tax. There's separate piles of money. This is how a VAT works. You've got the things you buy, that's a value, the non-tax expenses, and then you've got the taxes. And if you've got a value-added tax, what happens is you keep track of how much you paid in taxes, and then when you collect the taxes that's the next level up, you get to keep you get a refund for the amount that you paid in taxes from that transaction. So you're actually only paying for the value you added. Not all, the taxes don't accumulate on each other. You get the refund back. And, the way to do that and to have it done and call it a fair tax, instead of having it just be taxed at the end, which is what the consumer would see, the Retail Federation should say, instead of having a deduction for the taxes you pay, because that's what they do now. If you have a business, you can deduct the taxes, and you collect sales taxes. You can deduct those sales taxes from your tax forms, from your income on your Schedule C, and I'm sure corporations do the same thing, and partnerships do the same thing. That should be a rebate. So instead of deducting it and reducing your income, you should get every dollar back. Right now, even with no reforms, National Retail Federation and candidates, this is an important thing. Demand that every tax dollar that you pay in value added or sales taxes, you should get every dollar back. It shouldn't just be a deduction from your income. It should be a rebate. Every dollar you pay in taxes, you should get back from the IRS right now. Are you with me? Come on, capitalists. Are you with me? And if you do that, then the value-added tax is a natural ongoing thing when you do the fair tax. I mean, you do it, but you've got to start demanding first that you get every dollar you paid in taxes as part of your business back as a refund, not as a decrease to your income, but every dollar should come back to you. Every dollar. Demand that. That will stop the insanity of not having a VAT, because every other government has a VAT, and then the exporters don't pay it. Zero rated credited invoice VATs, as we're screwing our manufacturing section as usual. And also, if you do this, then rich people again would have to pay the tax. So no matter how they get the money, they've got to pay the full value of on the goods that they consume or on the investments they make through an asset. If they buy and have to pay an asset value added tax on the shares that they buy or the businesses that they establish, whatever they have to. If they go public, they have to pay the tax. That takes care of the need for capital gains taxes, which gets rid of the need to pay any income tax at all. If you don't want to do a direct payment for a bond for prepaying taxes, if you don't want to do that, and if you don't want to fund the debt with a tax, then that's essentially debt prepaid, which saves on the interest massively, and balances the budget instantly. Really, it does, because you're not paying the interest out, or not as much anyway. It saves money. And again, on the asset value added tax, doing that and then zero rating sales of stocks to an ESOP instead of just small businesses, it gives stockholders the same rights to sell to an ESOP for no taxes that personally held companies have now. So I'm just demanding, and this is important, I'm demanding that people who buy shares of stock get the same benefit as people who sell closely held company stock firms to their employees. I want equity here. If I've got 20,000 shares of Chevron or whatever, I should be able to, if I sell it to an ESOP that's from Chevron or whoever, if I sell to an ESOP, then I shouldn't have to pay any taxes on that for value added. Because if it was held by me, I could not pay tax. I could take a tax credit by selling to the employees. Well, any who sells capital stock should have the same benefit. Demand it. Demand full refund, full credit for any taxes you pay, and full exemption from taxes anytime you sell to an ESOP. These are tax cuts. If you're a Republican and you don't support this, then Grover Norquist should be coming for you. Two simple things. That saves the economy, and it saves government spending on interest. So, let's do it, people. Let's have a revolution. That's part 2.